Now, investment is fundamentally a little bit more sensitive to interest rates than the consumption is, because unlike consumption, a large part of investment that the firms make happens through borrowings, and it is largely a cost benefit decision. The firm is making that decision to invest because it expects certain return on a particular project or on a certain initiative. That expected return should exceed the cost of financing it. Suppose that a firm or a factory decides to pursue a particular project that promises a 12% return. But if the cost of pursuing that project is such that to borrow from the banks it would cost 8%, then the difference between 12% and 8% still makes the project look profitable. But if these interest rates were to go up and the borrowing costs were to jump to 10%, then the delta has reduced. It's now only 2%. And in certain cases, the project may now no longer make sense because the profits have got skewed up. So somebody may say, well, let's not go ahead with it right now. Let's postpone it and wait for the rates to become cheaper again. So the projects may get postponed and investment may fall. So investments and interest rates are related quite intuitively, that if interest rates were to go up, cost of borrowing has gone up. So investment, which is financed purely on the back of borrowings, will therefore reduce because the cost has gone up. Similarly, the opposite, when the interest rate falls, cheaper loans would make more projects viable. So firms which were holding certain projects at the margin would now be incentivized and say, let's do it, right? So firms will borrow more money, invest more. This means that the investment will go up if the interest rates were to come down. And as I mentioned, investment is more sensitive to interest rates than consumption, and you can see that in data also. And if the interest rates in India were to get cut by, let's say, 1%, then it actually raises investments by to the tune of 2%. And particularly the SME sector in India, because they rely heavily on the bank loans, they tend to respond much faster to the changes in the interest rate in both directions. If the banks tighten the credits or the rates are increased, then often the SMEs will cut down on their investments quite rapidly. But on an aggregate economy, there is still a lag. It doesn't usually happens instantaneously. When I mentioned that it will happen quickly, there is still a notion of at least 2 to 3 months that it would take for the full impact of rate changes to show up on investment decisions, because there are many frictions. There is approval frictions, somebody has to renegotiate the contracts, etc., etc. So once those frictions clears, the effect of the rate decision becomes much more visible. So now, just rolling it back, what have we discussed so far? Okay, we have discussed that the RBI controls the interest rates, that interest rates determines the consumption demand and investment demand. These two aggregate into the overall demand, and the overall demand therefore determines what the output is going to be. If you have an output that exceeds the potential output, then inflation is also going to be higher. If you have an output that is lower than its potential output, then inflation is going to be in control, but you will have unemployment and wastage and slack in the economy. All of this is transmitting through the rates. That is just one channel of monetary policy transmission. It is called as the interest rate channel, but there are other channels of monetary policy also. So let's look at what these other channels of monetary policy transmissions is.